Hello everyone. In this video, I will be discussing the risk and returns of our balance sheet activities, particularly with loan commitments. First of all, a small background with our balance sheet activities in Australia. The our balance sheet activities has been growing in a steady rate in Australia since the implementation of this off balance sheet business in 1989. And it has been growing in a high rate, particularly after the global financial crisis. For example, in 2010 and 2013, our balance sheet activities grew to 15 trillion and 23 trillion respectively. And the major off balance sheet activities in Australia are the commitments, direct credit substitutes, trade and performance related items, and derivatives, particularly futures and forward contracts, swaps, and options. And you can see how these off balance sheet activities have been growing from 1989 to 2013. And you can see that these off balance sheet activities have been growing at an average annual rate of 14.52%, and these are the yearly rates at which this off balance sheet activity has been growing. You can see that in each year they were growing at a positive rate, except 2009, where the growth rate was negative, and it's particularly due to the global financial crisis. You can see 2009 just immediately after the global financial crisis. However, after the global financial crisis, the growth rate is steady once again. You can see an exponential growth of the interest rate derivative contracts in Australia from June 1989 to 2016. So overall, off balance sheet business carried out by Australian banks have been growing at a very good rate since the 1990s. Now, the risk and return associated with off-balance sheet activities. In this video, I will be talking about the risk and return associated with loan commitments, and in the subsequent videos, I will be discussing risk and return associated with other off-balance sheet activities. And as I indicated earlier, that nowadays, most business loans are made by firms drawing down pre-negotiated lines of credit or loan commitments rather than borrowing on a spot loan basis. So just to remind you that a loan commitment agreement is a contractual commitment to lend to a firm a certain maximum amount, let's say $10 million at a given interest rate, let's say 12% fixed. The loan commitment agreement also defines the length of the time over which the borrower has the option to draw down this loan. In return for making this loan commitment, financial institution charge an upfront fee, let's say, which is 0.125% of the commitment size. So if the commitment is $10 million, then 0.125%, the upfront fee will be $12,500. So this fee will be charged irrespective of the amount of the loan the borrower withdraws. In addition, the financial institution must stand ready to supply this full commitment size, which is, let's say, $10 million at any time over the commitment period, say 1 year. So the borrower has a valuable option to draw down any amount between $0 to $10 million. So financial institution also charge the borrower a back-end fee, which is also known as commitment fee, on any unused balances in the commitment line at the end of the project. For example, let's say, although the commitment size was $10 million, the borrower withdraws $8 million. So unused balance is $2 million. So back-end fee is 0.25%. So bank will charge 0.25% on $2 million, which will be $5,000. So bank charges an upfront fee on the whole commitment size, and banks charges a back-end fee on the unused portion, and bank charges the regular interest rate on the amount borrowed. Now, what are the risks associated with these loan commitments? Now, first of all is interest rate risk. Interest rate risk is a contingent risk emanating from the fact that financial institution pre-commits to make loans available to a borrower over the commitment period at either some fixed interest rate as a fixed rate loan commitment or some variable rate as a variable rate loan commitment. Suppose the financial institution pre-commits to lend $10 million at 12% over the year and its cost of fund rises. The cost of funds may well rise to such a level as to make the spread between the 12% loan commitment and the cost of funds negative or very small. Moreover, the 12% may be much less than the rate the customer would have to pay if forced to borrow on the spot loan market under current interest rate. Okay, so one way the financial institution can control this risk is by making commitments with variable rates rather than fixed rates. For example, by making loan commitments indexed to some benchmark rate of interest, such as the 90-day bank accepted bill rate. So if this rate rises over the commitment period, so does the cost of commitment loans to the borrower. That is, borrower pays the market rate in effect at the time of drawing on the commitment. However, we need to understand the use of these variable rates does not totally eradicate the interest rate risk on loan commitments, because the benchmark rate may rise at a certain rate. However, the cost of fund of the bank may rise in a different rate. For example, if benchmark rate rises by 1%, but the cost of fund for the bank rises by 1.25%, the spread between the indexed commitment loan and the cost of fund narrows down by 0.25%. And this is known as basis risk. Loan commitment is also associated with drawdown risk. So especially in making the loan commitment, the financial institutions must always stand ready to provide the maximum of the commitment line, let's say $10 million in our example. The borrower has the flexible option to borrow anything between 0 and the $10 million, the ceiling on any business day on the commitment period. This exposes the financial institutions to a degree of future liquidity risk or uncertainty. The financial institution can never be absolutely sure when during the commitment period the borrower will arrive and demand the full $10 million or some portion. So the borrower could come to the bank and borrow different amounts over the period. The only constraint is the $10 million ceiling. Okay, so to some extent, at least the back-end fee or unused amounts is designed to create incentives for the borrower to draw down lines in full to avoid paying this fee. Loan commitment is also associated with credit risk. The financial institution often adds a risk premium based on the borrower's current assessment of the creditworthiness. For example, the borrower may be judged as a AA credit rate. The credit is paying 1% over the benchmark rate. However, suppose over the 1-year commitment period, the borrowing firm gets into difficulty, its earning declines so that its creditworthiness is downgraded to BBB. The problem for the financial institution is that the credit risk premium on the commitment has been preset to the AA level for the 1-year commitment period. To avoid being exposed to dramatic decline in borrower creditworthiness over the commitment period, most financial institutions include an adverse material change in condition clause, under which the financial institution can cancel or reprice the loan commitment if the borrower's creditworthiness declines dramatically. And last of all is the aggregate funding risk. Many large companies are likely to take out multiple commitments or credit lines with many financial institutions as insurance against future credit crunches. In a credit crunch, the supply of credit to borrowers is restricted, possibly due to restrictive monetary policy actions by the Reserve Bank. Another cause is an increased aversion towards lending by financial institutions, as was seen during the global financial crisis when banks were unwilling to lend to any but the most creditworthy loan applicants. In these credit crunches, borrowers with long-standing loan commitments are unlikely to be as credit constrained as those without loan commitment. However, this also implies that aggregate demands by borrowers to draw down loan commitments are likely to be greatest when the financial institution's borrowing and funding conditions are most costly and difficult. In difficult credit conditions, this aggregate commitment drawdown effect can raise the cost of funds above the normal level as many financial institutions scramble for funds to meet their commitment to customer. So you understand that this off-balance sheet item, loan commitments, is associated with interest rate risk, drawdown risk, credit risk, and aggregate funding risk. So when a financial institution involved in this activity, they need to have adequate measure for managing all this risk associated with this off-balance sheet item. Thank you very much. In the next video, I will discuss the risk and return associated with another very common off-balance sheet item, which is letter of credit.